And when you talk about the size of these deliveries, it's insanity. And so we are seeing structural deficits in silver again, which will be the fourth year in a row. And yet the price is being capped, as that capping is incentivizing big players to draw down to the point of 19 million ounces.
You're watching Silver News Daily. Subscribe for more.
What if I told you that the price of silver is being manipulated right now, and it's nowhere near what it should be? Sounds unbelievable, right? But here's the kicker. The true value of silver is on the verge of breaking free, and when it does, it's going to shake the financial markets like never before. Stay with me, because in today's video, we're going to uncover the hidden forces holding silver down and why silver stackers need to brace for a massive price correction that could change everything. Trust me, you don't want to miss this.
Yeah, well, we know from the meeting in Novograd a few weeks ago that 59 countries have formally applied, and we don't know which ones they are. We have some ideas. But one thing that did just get publicized on Monday, Bloomberg said that Turkey has formally asked to join BRICS and would be the first NATO member to request membership in the BRICS bloc. Think about that for a moment. And this is a very, very big deal. In fact, I was talking with someone who is a former high-ranking military advisor who I've talked with at length before. And I asked him, do you think Turkey stays in NATO? And he said, no, I don't think so. And now this is supposition, but they asked to join the European Union and they were rejected. And so I think they have doubled down. They're the largest purchaser of gold this year. And in our previous interviews, we've talked about the role of gold in the BRICS, which is the only other tier one asset in the world, and the possibility, at least agreed in principle, of the new unit settlement currency, which will be 40% gold backed, held within the borders of the countries that possess the gold to make the new unit token. And so you see Turkey being the largest producer or the largest accumulator of gold this year, formally requesting admittance into BRICS as a NATO member. Sides are being drawn. Sides are being chosen. And, you know, you got guys like Jim Willey who admittingly, he will say things that I've never heard before. And sometimes they sound outlandish and very often they come true. So I'm not disparaging his sources. But a lot of the sources that he gets, I don't know where he gets some of the info he gets, but some of it's pretty amazing. And he's said things before, like Japan and countries like Australia have interests in joining the BRICS. Now, we don't know that to be official. Haven't heard about it, but there will come a point, then again, where sides must be chosen. And this is one of them, a NATO alliance member, a Western-friendly member. And you just saw two naval sailors were just, almost abducted in broad daylight in Turkey yesterday. It's a country that is not maybe as Western friendly as we would like to think, yet they are part of NATO. And for them to choose sides and openly apply to BRICS while massively accumulating gold will tell you, you don't have to be a rocket scientist. They are dropping the crumbs at your feet. I think they are tired of the West. When the European Union turned them down, they would rather stand on their own 2 feet and join a union like the BRICS that is not only cooperative rather than coercive, but that provides them opportunities not found in the Western alliances. So it's a big deal. It's a very big deal. We don't know if they've been approved or anything along those lines, just that they have formally applied. And that is somewhat of the first time we've seen a Western ally, a NATO member, throw their hat in the ring, and where that goes and who it incentivizes to also be courageous enough to throw their hat into the ring. From here, only time will tell. But as the Chinese curse goes, we are certainly living in interesting times, and this is one of the more interesting developments we've seen BRICS related in quite some time.
Silver price manipulation isn't a new phenomenon. For years, financial institutions have been keeping the price of silver artificially low through complex market mechanisms. One of the most prominent methods is through paper contracts traded on the COMEX and LBMA exchanges. These contracts allow traders to buy and sell massive amounts of silver without ever taking delivery of the physical metal. In fact, 90% or more of these contracts are settled in cash, meaning there's no actual silver changing hands. This practice inflates the supply on paper, making it seem like there's more silver available than there really is, and it keeps prices lower than they should be. But here's the twist. Major players are quietly drawing down actual physical silver from the exchanges, and they're doing it in unprecedented amounts. This could be the beginning of the end for silver price manipulation.
2,500 and you're up in stratosphere land. And so you have all of these deliveries in gold. I'll talk about silver next, that are coming off of the exchanges because of the stupidity of the Western system that allows these commercial banks to suppress the price. And maybe they're being told from above. But the thing of it is that when these exchanges were established, long before the countries standing for delivery were coordinated, motivated, sophisticated, and wealthy, they offered a delivery mechanism, which usually never was activated or used. 1% or less of contracts in COMEX would stand for delivery, and now the number's much more. But let's talk about silver, which is crazy, because just a couple of days ago, which would, I believe, be the September contract, we saw 3,830 silver contracts stand for delivery at 5,000 ounces apiece. That's 19,150,000 ounces of silver that were delivered just a couple of days ago. And when you talk about the size of these deliveries, it's insanity. And so we are seeing structural deficits in silver again, which will be the fourth year in a row. And yet the price is being capped, as that capping is incentivizing big players to draw down to the point of 19 million ounces in one day. Now, it's not all one player, but suffice it to say, for an exchange like the COMEX, who had 19 million ounces delivered on the first day of the September contract, to see that happen when no one really ever stood for delivery, it should be very, very, very eye-opening. And to see the same kind of thing on gold should be very, very, very eye-opening. It is the draining of the exchanges that people in the West are ignoring. And this goes right into Zoltan Pozar's belief that he or she who has the commodities wins. So if I admire anything about the way that these countries, and I don't know how much of it is adversarial countries and sovereign wealth funds standing for delivery, and how much is the people in the know here, which I'm sure is a lot. But one thing I do admire about those who are standing for delivery and draining the exchanges is the methodical way in which they're doing it. And they're not doing too much to create Sunday evening news fodder. I mean, heaven forbid they ever talk about gold or gold being drained off of COMEX on the evening news or on Fox or CNBC or whatever, but enough to where it just glides on by, and month after month after month after month, we now see statements from the LBMA saying that they have the lowest amount of silver that they've had since they started keeping records in a 140-year-old exchange. Where's it all going? It's the stupidity of the way we price things, which is then incentivizing people to activate that frequently never or that rarely used clause of standing for delivery that is now becoming a release valve, if you will, and just plundering and draining the exchanges at our expense.
Now, let's talk about the real silver supply and why it's a ticking time bomb. In 2023, we saw a massive 15% supply deficit in the silver market, with demand outstripping supply by over 180 million ounces. And this trend isn't slowing down. In fact, between 2020 and 2024, the market is expected to face a cumulative deficit of over 1 billion ounces. The reason? Silver is becoming indispensable for modern technology. Solar panels, electric vehicles, and even AI systems all depend on silver. For example, the average solar panel alone requires 20 grams of silver, and electric vehicles need between 25 to 50 grams. With demand soaring and supply tightening, the imbalance between what's needed and what's available is becoming more extreme every year. So, why hasn't the price of silver skyrocketed yet? That's where the manipulation comes in. But as we'll see, this manipulation can't last forever.
Only surpassing the last 6 months. And of course, the largest buyer over the first 6 months has been Turkey, something I hope to talk with you about here in a few minutes as well. But when we talk about deliveries off of COMEX, we don't know who's taking all of these deliveries. We assume that in some cases they're commercial banks or maybe sovereign wealth funds or whomever it is. And, I have often, or for a long time now, I have been saying that it is the suppression of the Western paper market, where as much as 200 million ounces of gold is traded per day which is just absolutely ridiculous because, the LBMA says, yeah, 20 million ounces or so we trade every day, but that's 10 times understated because we only post the final settlement numbers. 200 million ounces a day and upwards ends of almost 3 billion ounces of silver, 3.5 times annual global mine supply, is traded in London. It is the suppression of the paper markets where 90% or more of those contracts are paper settled promises, not metal deliveries, but paper settlement, that is creating the distortions in the price and is keeping and has kept a lid on the price, and the rehypothecation that we see on COMEX, which has kept a lid on the price. And maybe that's why we see all of the countries repatriating their gold, taking it away from the Bank of England and the New York Fed, which was typically the access points for COMEX and the LBMA. And so that's already, we understand that. And much like the roll of toilet paper that I've talked about that spins faster and faster and faster, and you begin to see the cardboard, so too has been some of the deliveries we've seen recently. Gold delivered on the August contract so far is about 30% of the registered category, and that's the highest delivery in 4.5 years. Now, the registered category are the bars that back the contracts that are available for delivery. And when you talk about how big it was, I mean, you have to put it in numbers form to really understand. It was 4,142 contracts. Now, if we take 4,142 contracts in one day delivered, multiply that times 100, which is how many ounces are in a contract, obviously that's 414,200 ounces, and let's just call it times $2,500. That's $1,035,500,000. Who's got that kind of money to take possession of $1 billion worth of gold? And that's just in one day. But it's being drawn down from London as well, where in the second quarter, 330 tons or 10.6 million ounces were drawn down. Take 10.6 million and multiply times.
Let's really break down how paper markets are keeping silver prices artificially low. You see, the vast majority of silver traded on major exchanges like COMEX and LBMA is done through contracts that aren't backed by actual physical silver. These contracts are known as derivatives, essentially bets on the price of silver without any real metal changing hands. Here's where it gets interesting. These paper contracts can be issued in far greater numbers than there is physical silver available. For example, for every ounce of physical silver in the vaults, there could be dozens or even hundreds of paper ounces circulating in the market. This creates a false sense of abundance. But that's not all. Most of these contracts are settled in cash, meaning when the contract expires, instead of exchanging physical silver, the seller simply pays the buyer the difference in price. This process dilutes the real value of silver by keeping it tied to the paper market, not the actual physical supply. It's like promising hundreds of people the same bar of silver, knowing that only a fraction of them will ever ask for it. This is what's driving the suppression. The sheer volume of paper silver being traded allows large financial institutions to manipulate the price, keeping it lower than what supply and demand dynamics would dictate. And for years, this manipulation has benefited major players who want to keep precious metals prices low to maintain confidence in the fiat currency system, especially the US dollar. But here's where things start to get really interesting. Physical silver is quietly being drained from these exchanges. In recent months, we've seen massive deliveries of silver, such as the 19 million ounces delivered in just a single day on COMEX. These deliveries signal that big players are no longer content with paper silver. They're demanding the real thing. And this is where the game starts to shift. As more and more physical silver is taken off the market, it becomes harder for the paper market to suppress prices. The fewer real ounces backing those contracts, the more fragile the entire system becomes. At some point, the market will no longer be able to hide the truth, and when that happens, the true price of silver will emerge. And trust me, that price is going to be much higher than what we're seeing now.
I mean, just in the numbers that you mentioned from quarter one 23 to quarter one 2024, that's about 130% increase. And that goes to show that the transferring of these liabilities to insurance companies is a byproduct of the environment of uncertain economic times, inflationary pressures, geopolitical pressures, stupidity of our leadership, the end of the era of low interest rates, perhaps. I mean, we're not ever going back to zero bound. If we do, this country's dead. But these are the quandaries that are facing these pension administrators. And you're right, they typically will give those pensions to insurance companies. And, I think it becomes very concerning to me when you realize that, these insurance companies are loaded with things like treasuries. And what happens to their ability to AIG was a reinsurer, if I'm not mistaken, and they reinsure the insurance companies. They're the ones who are insuring the insurance companies because it would lead to a systemic failure if rates were to spike, as we've talked about before, if all of a sudden the dollar was dumped, Operation Sandman, or they end up saying in October, we're going to issue the unit like we've talked about. It's not just in theory and in principle, but it's real. And now the need to hold dollars in treasuries wanes and they get dumped. And so the Federal Reserve is the only one dumb enough to buy them, which leads to hyperinflation. But this is the kind of nonsense that these pension administrators are thinking about. And it becomes a little concerning when you realize that all of these annuity contracts are issued in a small number of insurers. And you're talking about massive systemic risk where, you got a handful of the very biggest insurers who are, I'll take this huge lump sum. That's amazing. And I'll take on your liability. Well, why do you think the pensions are getting out of it? Because the actuarials and the numbers that they've used really don't, they're concerned about going forward. People are living longer and it's harder to go out into the future and to make these returns and to feel safe about guaranteeing them. So they're offloading the liability to the insurance companies and washing their hands of it. But, when we talk about insurance companies in the United States, I don't know how many have failed in the last 20, 30 years, but the number's got to be close to 100, I would think. Insurance companies fail too. And in a rising interest rate environment, when you see these companies have been loaded or are typically loaded up on treasuries, in an environment where treasuries are becoming more dangerous, this whole thing, it's a powder.
Now, let's dig into one of the biggest signs that silver manipulation is approaching its breaking point: the massive drain of physical silver from the exchanges. In just one day, COMEX saw a delivery of 19 million ounces of silver. To put that in perspective, this is far from normal. Typically, only a small percentage of contracts stand for physical delivery. Most traders are content to settle in cash because it's faster and more convenient. But when major players start demanding physical silver in such large quantities, it's a red flag that something big is brewing. This isn't just happening in the U.S. exchanges either. London, another global hub for silver trading, has been experiencing similar trends. Recently, the amount of silver held in London's vaults dropped by 1.4%, which is a significant decrease considering the sheer volume they normally store. What we're witnessing is the quiet removal of physical silver from the market, and this isn't a coincidence. Wealthy institutions, sovereign wealth funds, and even countries are recognizing that the paper market is shaky and could collapse under the strain of real demand. Think about it. When large financial players start pulling actual silver off the market, they're hedging against something. These players understand that if too many contracts stand for physical delivery and there isn't enough silver to back them, the system will implode. And once that happens, silver's true scarcity will be exposed. What's even more telling is that this isn't getting much mainstream attention. You won't hear about these massive deliveries or vault drawdowns on major financial news networks. It's all happening behind the scenes, but the signs are there for those who are paying attention. The physical silver market is being drained, And the paper market's grip on the price can only last so long.
China's flying all around Latin America and buying up all the doré and concentrate and shipping it back to China to refine it. How many people know that China is the second largest producer of silver in the world and now buying concentrate and doré at up to twice what the West will pay for it, shipping it home and refining it, so it doesn't have the transparency or affect the price settlement the way that it would coming off of an exchange? You have these countries using the brain-dead Western suppression against us, draining the exchanges, making massive deliveries across the globe, and now even disintermediating the whole system and going right to the miners and buying their doré. So it's a big deal. I mean, I don't know how much bigger of a deal than I can explain it than to say these countries are every bit as sophisticated or more so than the West. And in fact, they know what we're doing, and we've documented that on all sorts of things that they've said, like the head of the Shanghai Exchange in 2015 saying, when China's allowed to speak at the gold table, the real price will be observed, or the BRICS Grain Exchange saying we produce more grain than the West, but we can't control the price. It's done on COMEX. That will change now with the BRICS Grain Exchange. They know what we're doing to the world's commodities. They know we're suppressing them. So instead of raising a fuss about it, they're just draining it and buying it everywhere and anywhere they can, even in unrefined form. And it goes right past the watching eye of the mainstream. It goes right past the watching eye of Wall Street. And you got to come to Liberty and Finance to find that. It's just a joke. But it elevates what we're talking about to supreme importance, because you can't get out of the way of what you don't see coming. And in this case, you can't take advantage of what could be a once-in-a-generation shift unless you know it's shifting. And indeed, by the actions of these countries, it's shifting. The amount of deliveries that we are seeing is so unprecedented, it's not even funny. And it will get to a point where at some point, the exchanges that have grown to be accepted for up to 140 years, the LBMA and the COMEX in 74, will be rendered the same way Bernie Madoff was, as a scam and as a Ponzi scheme. And the Shanghai Metals Exchange, which has increased over 200% in volume in the past several months, has now surpassed in trading volume the COMEX. So these little by little moments are becoming far more legitimate, and it baffles me how underestimating this is really, how the mainstream underestimates it, how Wall Street underestimates it or completely ignores it. I think this is a massive deal, a huge deal, and all you got to do is not listen to what people are saying, but do what the biggest money in the world is doing, those who know the playbook, and that is accumulating commodities, period. Selling treasuries, selling dollars, getting out of the way of what's coming and buying commodities which have, as we know, no counterparty risk when held in your own possession.
Let's shift our focus to one of the most crucial players in the silver market, India. This country's insatiable appetite for physical silver is another key factor that's driving the market toward a tipping point. In February 2024 alone, India imported a staggering 2,295 tons of silver, more than the U.S. Mint has produced in silver eagles over the last 3 years combined. And this wasn't just a one-time event. India's silver imports have been on a steep rise, with analysts projecting that the country's total imports to reach over 7,000 tons by the end of the year. Why is India buying so much silver? For one, silver is deeply ingrained in Indian culture, used in everything from jewelry to religious ceremonies. But more importantly, Indian industries are consuming vast amounts of silver for manufacturing and technology. The demand for physical silver in India is so high that it's causing a serious strain on global supply. And while India continues to soak up huge quantities of silver, the rest of the world is left dealing with a market where supply simply can't keep up with demand. This massive demand is especially alarming when we consider how much silver India has already imported in recent years, over 700 million ounces. That's more than the combined amount of silver available for delivery on the COMEX and LBMA exchanges. Think about that for a moment. India is quietly draining more silver than what's available in two of the largest silver markets in the world. Here's why this matters. As India continues to absorb physical silver, the amount available for delivery on these major exchanges dwindles. And when the time comes for more contracts to be settled in physical silver, the supply may simply not be there. This puts even more pressure on the paper market. And when demand outstrips supply to this degree, prices can no longer be artificially suppressed. India's aggressive silver imports are a major sign that the world is waking up to the true value of this precious metal. The question is, are silver stackers in the West ready for the consequences when the market finally reflects this reality?
So 2024 will be another deficit, and they imagine 215 million ounce shortfall, second largest in more than 20 years, fourth year in a row of a structural deficit. Of course, the supply demand numbers do not put in military usage, and that's a big deal for me. When we go back to the congressional hearings, Senate hearings, subcommittee hearings in the 40s that I've talked about, I've shown you, that talk about needing 200 million ounces of silver per year in the 40s. Well, we've talked at length about the need for silver in high-tech weaponry, and those supply-demand numbers that the Silver Institute publishes, right or wrong, will tell you there's a 215 million ounce deficit on the horizon for this year, the fourth year in a row. But they don't mention anything about military. So my guess is those numbers are much, much higher. And this is why you have 8 brain-dead banks holding the price of silver down. All right, now going to India, it was just reported August 23rd that India's silver imports are on course to nearly double this year. And they're going to double to, the country has already bought 2,295 tons compared to only 673. This was in February alone. In February, 1 month. And they published these numbers months after. In 1 month, they bought 2,295 tons of gold in February. And that's up from 637 tons in January. So you're talking a 260% increase month over month. That's massive amount of silver. Putting that in perspective, okay, that amount of silver that they bought in 1 month is 70 million ounces more in silver than the U.S. Mint made in silver eagle coins over the past 3 years combined. So you got India importing more silver in 1 month than the U.S. Mint has made in eagles in 3 years combined. Think about that for a moment. They are estimating that upwards ends of 7,000 tons will be imported this year. And I mean, last year was 4,554 tons and 560 tons the year before. So 560 jumps up to 4,554, jumps up to 7,000. Their numbers are massive, and they've imported over 700 million ounces in the last few years. That's so much more than is on COMEX and LBMA combined for delivery. It's not even funny. And that's just what they tell us. And as I mentioned to you probably last week in an interview I did with Sean Kuhn from Dolly Varden, he says, look, Andy.
Silver isn't just another commodity. It's a cornerstone of the new technological economy. As we move further into the age of renewable energy and advanced technology, silver's role becomes more critical than ever. Solar panels, which are driving the global shift toward renewable energy, require significant amounts of silver. On average, each solar panel uses about 20 grams of silver. With the global push toward green energy, demand for solar panels is only increasing, putting even more pressure on the silver supply. And it's not just solar power. Electric vehicles, which are transforming the auto industry, use between 25 and 50 grams of silver per car. The growth of electric vehicle adoption is projected to skyrocket over the next decade, adding to the already surging demand for silver. But that's not all. Silver is also a key material in the production of semiconductors, sensors, and even lidar technology, which are all crucial components in AI-enabled transport systems. As AI and automation become more integrated into industries worldwide, silver's applications will continue to expand. What's even more alarming is the production side of things. While silver's demand is booming, production is struggling to keep pace. Most silver today is mined as a byproduct of other metals like gold and copper, meaning there's a lack of direct investment into new silver mines. Existing mines are also facing issues like declining ore grades, making it harder to extract silver at the levels needed to meet demand. This is a recipe for a severe supply crunch in the near future. As the world becomes increasingly dependent on silver for everything from clean energy to cutting-edge technology, The gap between supply and demand is only going to widen. We're already seeing structural deficits in the silver market, and with no immediate solutions on the horizon, this imbalance could trigger a massive revaluation of silver's price. The big question is, will the market correct itself before it's too late for those who haven't prepared?
Keg. It truly is a powder keg waiting to happen. And I just think it's wise of these companies to offload this responsibility. But I think it puts a target on the insurance industry and makes the insurance industry one that is, again, arguably very overleveraged and undercapitalized to maintain these lofty expectations. And if something happens in the economy that disrupts their normal course of business, what happens to all of these pensions? Does this go bye-bye? I'm not sure, but I think that when people have the choice, they're either given a lump sum or an annuity. Well, with a lump sum, now you're forced to managing it yourself. And all of this money you thought about for retirement, you now have to manage. Yeah, you could put that into gold. But now you have the quandary. It used to be you knew your retirement was safe and secure and you were set. And now you're thinking, geez, I got to manage this myself. I don't know how to do that. What am I going to do? Do I put it in bad things? Do I put it in the stock market right before a crash? Don't know. Or I can get an annuity cut off of an insurance company that, I would argue, I have said for the last year or two, insurance companies are square in the target of a reset. If you see interest rates spike because of a dollar dump, if you think the insurance companies are scot-free, safe from all of that, I got a bridge to sell you. It ain't going to happen because they are loaded up with treasuries. They are very interest rate sensitive. So it's a dangerous thing, but what it is, it's an indictment of the system. These people running the pensions, they're actuarials, they're smart, they see where things are going, they see the trends, and the fact that you see 130% increase year over year. One of my very dearest friends, he's about 10 years older than me, but he was an executive at International Paper for a long time and has an amazing pension where he gets like $130 or $40 or $50,000 every single year. And if he dies, his wife gets it. I mean, it's crazy, but I remember him telling me, I don't know how many years ago, 7, 8 years ago, that he was the last year IP stopped doing pensions a while ago because these companies know. I mean, look at the pensions, the underfunding of pensions all around the world, all around the country, rather, in municipalities, in cities, and in corporations. It will lead to the downfall. Look at the police and fire and the teacher pension in Chicago. I mean, it's like 50 cents on the dollar funded. So pensions are a big problem, and to see them offloaded to insurance companies is only very logical, but it's an indictment of the system, and I think it makes the insurance companies who hold it that much more risky, if you will, from a forward-looking perspective.
We've covered how silver is being drained from the exchanges, how massive global demand is straining supply, and how paper contracts are suppressing prices. Now let's bring it all together to understand why silver manipulation is at a breaking point and what that means for the price of silver moving forward. The reality is this: the forces holding silver prices down cannot continue indefinitely. With physical silver being removed from the market at unprecedented rates, whether it's sovereign wealth funds, institutions, or countries like India, the paper market is becoming increasingly fragile. At some point, the number of paper contracts issued on COMEX and LBMA won't be able to hide the fact that there simply isn't enough silver to meet real-world demand. When that tipping point arrives, silver prices could surge like never before. Picture this: as the physical silver supply dries up, investors holding paper contracts will begin demanding physical delivery. But what happens when the vaults are empty? A scramble for physical silver will ensue, pushing prices to levels we haven't seen in modern history. This isn't just speculation. It's simple supply and demand economics at play. The only thing keeping silver's true value under wraps is the artificial supply created by the paper market, and that manipulation is becoming unsustainable. For silver stackers, the message is clear. The correction is coming. As the market finally reflects silver's true scarcity and strategic importance, those holding physical silver could stand to benefit enormously. We're on the brink of a historic price revaluation, and the time to prepare is now. But remember, this isn't financial advice. It's an analysis of market forces that are already in motion. If you're serious about protecting your wealth, Pay close attention to how the silver market unfolds in the coming months. And before you go, make sure to hit that subscribe button to stay updated on the latest developments in the silver market. You won't want to miss what's coming next.